Thank you for those of us who are joining us, wherever it is, whether it's your morning, good afternoon, good evening. This is Block Asset Management, the world's first digital asset and blockchain fund of funds, and LehmanBush, the Asia investment arm of the Bush family. And we're also Block Asset Management's official Asia partner. And we are delighted to bring to you the leading names in digital asset funds, debating how best to invest in digital assets. But please be advised, we will not be talking about what blockchain and Bitcoin are tonight. We will not be talking about where prices are going or where the industry will be in 5 years. Instead, this event is meant to address the hard questions about investing in digital assets that you have as an institutional investor. And to those questions, ladies and gentlemen, a panel of crypto hedge fund stars whose reputation precedes them. Joining us is Dan Morehead. Dan was a Goldman Sachs trader and global head of FX options at Deutsche Bank before founding his own FX platform and then founding Pantera in 2013. Pantera is America's first Bitcoin investment firm and is undoubtedly the most recognized fund in the space, returning billions to its investors. Welcome, Dan. Good to have you. Also with us is Desiree Muller, a former portfolio manager at Credit Suisse. Desiree is the CEO of SwissRex AG, whose fund is one of the industry's best kept secrets, consistently outperforming most other funds and driven by research, the valuable product in its own right. Thanks for joining us, Desiree. Also joining us is Jeff Dorman, CIO of Arca Funds. In addition to 2 decades of portfolio management, he's also served as COO of major fintech firm Harvest Exchange. His widely read blog, That's Our Two Satoshis, demonstrates his unparalleled understanding of both the macro and micro events driving the digital asset industry and market. Welcome, Jeff. Next, we have a veteran derivatives and options trader for the likes of Paribas and Deutsche Bank. He went on to found the award-winning multi-billion-dollar asset management group Trafalgar. Now founder of the Altana Wealth Fund, he's sought after as both a writer and speaker on digital asset investment. Welcome to you, Mr. Lee Robinson. Also with us is Kyle Samani, a software engineer whose skill and dedication led him to found and serve as CEO of a smart glasses venture that was acquired in 2017. His deep technical understanding of blockchain plays a critical role in the success of Multicoin, which is known for pioneering token economic models and valuation methodologies. Thanks for joining us, Kyle. Ultimately, we hope we have with us Brian Kelly, an investor. He's the author of The Bitcoin Big Bang and a sought-after commentator. Brian is also a successful serial investment firm entrepreneur. His latest venture, BKCM, offers a flagship fund that actively manages a portfolio of digital currencies. So welcome, Brian, if you're joining us. I'm your moderator, Ernie Diaz from LehmanBush, and I'm also joined by moderator Kevin Ballard and our host, Manuel de Luque Montaner of Block Asset Management. So it's time to start. And a reminder first to all, we won't be presenting the funds themselves, but rather how their managers' strategies and insights may or may not align with your goals. Of course, more information on all these great funds will be made available following our Q&A. But first, we're going to break this panel into 3 phases. First is diversifying into crypto assets, its challenges. Second, whether or how to diversify into that fund that's right for you. And third, we'll finally be debating on whether investing in a fund of funds is the ultimate diversification. So for phase 1, we're here because we believe we need exposure to digital assets. But that in itself brings up a lot of questions and challenges, as I'm sure our panel will agree. So for our first question, it's one we run into a lot, is shouldn't we just invest in Bitcoin? I mean, it's comparable to the Amazon or Google, say, of cryptocurrency. So we can assume that it's safe for the long term. And all these lesser known cryptos could very possibly die a MySpace or a shop.com death. So to be polite and ladies first, Desiree, could you let us know what you think, what you would say to an institutional investor who's thinking, you know, maybe I'll just go long Bitcoin?
Hi, everyone. It's my pleasure to be on the call. Yeah, as you say, I also think Bitcoin is already comparable to the Amazons and Googles of this world. It already has a big brand and a large market capitalization, but I personally would have loved to buy Google when the valuation was still below 1 million around the year 2000. And that's also the projects I'm trying to find in the crypto space. The hidden gems in the back rows on place 30, 40, 50 in terms of market capitalization, but with good fundamentals and business models. That's the ones I want to have in my portfolio. But in the end, as you say, it's a young industry. Many of the 5,000 tokens that are currently being traded on exchanges will die. And that's why I believe in active management.
Good point. And Lee, as we've noted on your site, and as you said, the majority of your fund's value is currently derived from the price movement of Bitcoin. So are you a little more pro Bitcoin, and of course not all chips on, but what's your view on that question of just weighting heavily towards Bitcoin, say, whether you're active or passive?
Well, we're heavily weighted towards Bitcoin at the moment, but that can change. And from our point of view, the crypto space is still relatively young, right? It's 10 years old, just over 10 years old. So the winner could well be, and probably will be, something else other than Bitcoin, and something else will come out there. There is such a demand for peer-to-peer currency. It's going to be worth trillions of dollars, that somebody's going to work on something that is better than Bitcoin, and eventually there. The prize is so big that it's not going to be ignored. And you seem to forget that this is not a relatively speaking quite small currency compared to, say, gold, or compared to silver, or compared to the Mexican peso or something like that. So we definitely think that you should be cognizant of the fact that somebody else will come in, and that's why, sadly, in this space, you need to go to a third-party manager and seek their advice.
I want to follow up on why you said sadly, but to keep it with Bitcoin, because you said something intriguingly and great point about the relatively small market cap value of Bitcoin in its own right. Are you hinting that it could be a MySpace? Do you have other coins that you have more faith in? I wouldn't imagine it's Ether. All that talk of the flippening was a good 3 years ago, if I remember correctly.
Look, you pay a manager for many things, but one of the things the manager does is provide a service, and provides custody, provides the ability to give you insight, but also to pick the winners. And Amazon could have fallen by the wayside, and Google could have been beaten by Yahoo. Who knows? But the point is here, we are at the moment of the view that Bitcoin is the winner, and has been for a number of years. But we are open-minded to the fact that over time something else will come along. And the nice thing about digital currencies are that they're very transparent, they're very easy to find. And if one of them is suddenly going from number 1,000 to number 10 in market capitalization, we're going to notice it, and we're going to think very hard about switching. And we were involved quite heavily in Litecoin in 14 and 15 at the very beginning, and of course, no one talks about it anymore. And the technology behind Litecoin was excellent, and arguably in some ways better than Ethereum. But of course, the trends change. So we're open-minded, but this is why you pay a manager. He's meant to be looking and protecting your back and making sure that he changes from Bitcoin to something else.
I appreciate you, Lee. Thanks for that. I mean, yes, in this phase, we're kind of trying to explore about the challenges of just exposing our portfolios to digital assets. I know you've got some great points to make about how to diversify with a fund and the benefits of that kind of active management. But let me move to a second question, please, because this is an important one. Yes, everybody, so many people don't even know the difference between Bitcoin and blockchain. It may surprise some potential investors that there's far more to the investable digital asset universe than Bitcoin and even other cryptocurrencies. There are quite a few sectors of this ecosystem. So I'd like to ask Kyle, which do you find most compelling? If we can put this in terms of reducing risk through diversified investing, because ladies and gentlemen, you should know that Multicoin is quite visionary. They invest in all sorts of even startup blockchain companies. So I'm kind of throwing you a curveball, Kyle. Can you tell us about some of the other sectors available, but which ones you find compelling from an institutional investor standpoint who's interested in, diversification as risk management?
Sure. So the way we think about crypto is, what does this kind of core technology do? The internet was a new way to send information around. And in 1994, it was kind of hard to understand what is the information arbitrage gap like, and how do you make information travel more efficiently? And that was a very abstract, right, thinking, and people didn't understand what that is. When I look at crypto, crypto is really about reducing trust for people to engage in financial contracts or technical contracts of sorts. And so we wrote an essay a little more than a year ago. What we call the crypto mega theses that like encapsulated our kind of I've been in this space now kind of 4 years full time and 3 years professionally, taking all of that kind of thinking and distilling it into 3 core theses, all of which are fundamentally about reducing trust between parties that engage in some contract. And the first of those theses we outlined what we call open finance. That's also sometimes referred to as DeFi, which is kind of a buzzword right now if you're in the crypto community. Open finance is really about enabling either bilateral, trilateral, or multilateral contracts between large numbers of parties to work where there is no middleman, there is no counterparty risk, where you have code that can arbitrate disputes and manage large-scale contracts. A simple example of that would be like a money market, where you have lots of money going in and lots of money being borrowed from that pool. Second major thesis that we invest along is we call Web3, which is really about enabling increased access to data and about managing kind of data online. A lot of these opportunities we're seeing today are around like increasing internet access in things like Helium and Arweave. And then the third major thesis is the opportunity for non-sovereign money, or is what's more kind of colloquially known as digital gold, which is really reflected by the Bitcoin thesis. Each of these 3 theses, we believe, is $1 trillion over the next decade.
Each of these theses is $1 trillion, you're saying?
It will be a multi-trillion-dollar opportunity over the next decade. And so we spend our time really deep in the weeds understanding those opportunities and making pretty concentrated bets along each of them.
All right, I thank you for that. A broad view of the potential of blockchain, what with Web3 and trustless contracts. But respectfully, the age of the decentralization zealot has been put on hold. And I've got to say, a lot of our institutional investors, they like to hear that talk. It's all very exciting, but we're really trying to drill down on what are kind of investable opportunities like DeFi you mentioned. Jeff of Arca, Arca Funds, would you care to drill down a bit and let us know about some of the verticals that you find particularly interesting besides just going long short on a basket of cryptocurrencies?
Sure, thank you. And first of all, I don't even use the word cryptocurrency very often. I use digital assets. I think cryptocurrency is one very important, but albeit actually kind of a small subsector of the digital asset space. So the way we think about this space is you've got 4 basic types of digital assets to invest in. You have your money or your currency, similar to what Kyle just said. Some of this is store of gold. There could be other reasons for currency. But these are the types of digital assets that are meant to be money, whether that's Bitcoin, Litecoin, et cetera. And I think like most people on this panel, Bitcoin is far and away above everything else trying to be money. Then you have your protocols and your platforms. This is really what the 2017, 2018 wave was everybody trying to create a new, better blockchain, whether that was faster, more decentralized, whatever. We almost never invest in any of those. I think it's much more of a venture capital type investment where it's a winner take all, but you're going to have a lot more losers than you will winners. And that's not something that really accrues a lot of value in our opinion. But the third and fourth types of digital assets are much more interesting to us. And those are asset-backed tokens, tokens that are actually backed by a real asset, whether that's fixed income, equity, or hard assets. There's not very many of those yet, but that's definitely coming. You've even seen examples of like an NBA player trying to tokenize his salary. That's a good example of an asset-backed opportunity where there's a real valuation technique behind it. And then the fourth is probably the most interesting to us, which is what we call pass-through tokens. These are tokens that have very flexible mandates in terms of what you're getting when you buy them. It can be part utility, it could be quasi-equity, it could be an amortization feature, it can be a way to bootstrap a network, but these are tokens that actually accrue real economic value when you own them. And we look at this space much like the fixed income market, which is you can no longer just say, I'm a fixed income investor, because the next question is, well, what does that mean? Are you invested in munis or govies or corporates? Are you invested in investment grade, high yield, distressed, preferreds with warrants? It's a huge, unique ecosystem in fixed income, which requires a 4-page book. And by trying to flip, you even understand any of the elements of fixed income. That's what the digital asset space is now. Each token is designed differently, and you need to understand them in a totally different way to invest.
Thank you for that, Jeff, and extremely interesting. but I believe the gauntlet has been thrown, because if I heard you right, you don't find the venture side of blockchain interesting. And Dan, you know, on Pantera's site, it says you focus on ventures and blockchain projects. Would you care to counter and illuminate what is still interesting, if indeed you still are interested in venture and blockchain projects and investing along those lines?
Oh yeah, we invest in the whole blockchain space. So we invest in venture companies, we invest in very liquid blockchains like Ethereum and Bitcoin. And then we also invest in new projects that are being launched and are going to be new tokens. We see value in the whole spectrum. You know, there's pros and cons. Bitcoin's incredibly liquid, but you know, it's very volatile, and the chance it goes up 100x from here is pretty small. However, some of the venture projects we invest in, or some of the young token projects, they can go up 100x. So, you know, we want to offer that to our investors, the ability to get either really liquid things that have more certainty, or illiquid things that, you know, could have more upside.
Thanks for that, Dan. Go ahead. Sorry. Okay, so we're kind of venturing to keep it. One last question on the exposure to digital asset side, not about the hedge fund per se, is that as responsible investors, we should know what we're putting our money into. You know, a lot of what funds and everyone's investing in now are crypto derivatives, Bitcoin futures particularly, and that whole space can be quite opaque and illiquid. So for those of you who are weighted towards derivative trading, shouldn't we wait until there's more adoption and transparency in the space if we're truly interested in diversification and risk management? Is Brian with us? Brian Kelly, would you like to field that one?
Hey, all, I'm here. I apologize for being a bit late there.
No worries, Brian. Better late than never. Great to have you.
Good to be here. So listen, yeah, Bitcoin derivatives, Bitcoin futures have been a big part of the investing. And actually, you know, for institutional investors that already are either a CTA, registered with the NFA, or already have kind of the pipes into the futures and derivatives exchanges, it's a pretty easy way to get into the space. You know, and you can continue to do that. And they're actually getting a lot more liquid than they have been in the past. So you're trading some serious volumes there. You can get in and out of stuff pretty easily. I mean, I remember, you know, when I started, I got into this in 2013, 2012, 2013. And, you know, if you did a $50,000 order, that was a big order, right? Now you could buy $5 or $10 million worth of Bitcoin with the push of a button. So things have changed dramatically. I think it's a way to kind of dip your toe in the pool and see what it's like and get that diversification. But I would agree with everybody else. There's a lot more to this than just Bitcoin. I mean, what we're really investing in, and the way that we look at it, is that, you know, you have a new economic structure here called the crypto economic network. And the token part of it needs to act like a currency, needs to have some kind of incentive for investors to be involved in that. So that's what we look for. And there's a whole range of them. I mean, there's 10,000 cryptocurrencies now. You know, probably 9,900 of them are going to go to zero. But the other 100 are pretty interesting.
Okay. I like the way you frame that. Thank you, Brian. So we'll wrap up the first phase then. Thank you for those insights on the market itself, different areas that we can be investing in. And it's probably too early to summarize, but I do want to transition into the panel's specialty, which is the merits of active management and investing in a hedge fund as opposed to other strategies. So if I can move into the second phase of diversification, which has to do with choosing a fund. You know, traditional hedge funds, I'm sure you're aware, are taking heat for underperforming compared to the market and ETFs. Respectfully, many crypto hedge funds are returning less to investors, obviously for obvious reasons, than in the frothy 2016-17 crypto market. So Desiree, you know, you're well known. SwissRex is well known for its very valuable research. People pay good money for it. And you talk about actively analyzing and finding the best tokens to invest in. But, you know, again, I'm an institutional investor. It's all about diversification and risk management. Why would you recommend an investor expose her portfolio to digital assets, to consider a fund first, rather than say a cryptocurrency ETF. I could get into a couple of ETFs mirroring the trend in equities, you know, the top 10 currencies and ETF are up and coming. Wouldn't I have comparable diversification and therefore a chance at gradual upside?
So in my opinion, crypto is a very young and inefficient market. And there are great opportunities to generate alpha by doing active management. I mean, compared to equity markets, they are already very mature. We are more in the hedge fund industry 50 years ago. So there are great opportunities, of course, with certain risks. But once there are no more risks, there will be much less upside. And actually in Switzerland, we already have some FINMA regulated banks, crypto banks, and brokers, which we can use, which give us a very good infrastructure to do very safe trading and storage of tokens.
Excellent. Thank you for that.
I'd like to jump in there too for a second, actually. You mentioned really quickly risk management and diversification as if they're similar. They're very different. Risk management is not only protection against downside prices and doing things to protect against price movements, but also the service providers that you use, the auditors, the accountants, everything involved in risk management is much bigger than just price movements. And also on the diversification side too, with indexes in equities or fixed income are great after 50 to 100 years of data, and that it's actually representative of the universe. The indexes that exist today, if they're market weighted, they're pretty much just Bitcoin. They're 85 to 90% Bitcoin. That is not representative of what the space is anymore. And even if they're equal weighted, it's largely just what we talked about earlier, which is cryptocurrencies, which is a very important but not an all-encompassing area of the digital asset space. So diversification is great if it's actually representative of what you think it is. The indexes that exist today are not representative of this space. And again, risk management, I don't think diversification gets you to risk management. I think it's all the other things that an active manager does that helps you with risk management.
That's a great point. Thank you for that. Yes, a good point about the risk management. I mean, it's trite to say. I realize that because it has so many aspects, but then maybe I can open things up by mentioning that, a lot of the, at least the Asian investors that LehmanBush is talking to, they're willing to expose, on average, 5 to 10% of their portfolios to digital assets. They're ready to go, but they worry about regulations in America, the legal environment. Everybody's worried about platform hacks and custody. So maybe Dan, maybe you could lead us off by telling us about what specific risk mitigation strategies you have in place to make investors comfortable with sizable allocations in terms of some kind of stack, if you can describe it in a concise way, please.
Yeah, we started off in 2011 and it was the Wild West. There were no custodians. I had 250,000 Bitcoins in my head. It was a pretty wild era. It's so different now. You have this Chicago Mercantile Exchange doing custody. You have the New York Stock Exchange doing custody. And the regulatory issues, which were real 4 or 5 years ago, really, I think are all behind us. All the agencies in the US have ruled. They've all been neutral to positive. And so all those worries that we had that were valid 4 or 5 years ago, I really think are behind us. And that's why you're seeing massive institutions. All the biggest endowments have exposure to crypto now. And they wouldn't do it if all of those I's weren't dotted and T's weren't crossed. So that era, the Wild West, was fun and interesting, but that was a while ago. And now institutions are piling into the space because you have regulated custodians, because the regulations are very clear. So there really aren't any major hurdles.
So you're saying there's no even gray swan, let alone black swan, some kind of, presidential demented swoop of the pen or SEC kind of rug slipping banana peel that could cause some major upset that a sharp hedge fund manager couldn't foresee and deal with easily?
Yeah, I don't think so. Obviously, it's a high vol market. The market goes up 1,000% some years. It goes down 80% other years. But that's just really from trading mania. It's such a powerful opportunity. People sometimes get ahead of themselves, and then pessimism pops in. The market's been averaging 209% compound annual growth for 9 years. That is going to have some wild days up and down. but I don't see any kind of institutional risk. Your example of say a president, writing some crazy legislation, that's the whole point of Bitcoin. No, but it's censorship free, right? Like you can't stop it. And so I think that is its kind of main feature, is that there's no single person on earth that could slow the project down. And it's not to say we won't have bubbles and we won't have busts, but I think, we've reached escape velocity. There's, probably 50 million people using it. All the major endowments own it, so it's essentially not going away.
All right, fair enough. Thank you for that. And, ladies and gentlemen who are attending, these are stars in the digital asset hedge fund field. I'm not going to use the C word right now, further to request. And the point being that maybe we can take kind of a left turn. Rather than explaining why you're the ideal fund, maybe we could start with you, Lee, because you have an award-winning fund, Altana Wealth. Could you briefly outline who your ideal client would be? Who do you think is a potential match? Tell us, if you meet the requirements and have the dry powder. We would also ask that you have this kind of investment philosophy. Who's your ideal client, Lee, to work with, besides someone who doesn't call too often?
Somebody who gives me money as an ideal client, I think that's probably the case. I think, look, I think Dan talked about it a little bit as well. What we've seen differently over the last 2 years is institutional money, and most of our money was high net worth people who were traders originally, people who who just thought, I'll have a small exposure and see how this goes. And then suddenly last year, I don't know what really caused it, maybe a lot of the factors that Dan mentioned, but suddenly institutions were like, we need to have 0.5%. We need to have 0.5% in our portfolio in this, which sounds tiny, but actually it's an enormous number right across these big institutions. And so for us, I guess, yes, an ideal investor is somebody of that sort of background who wants to get bigger, wants to learn about it, can see that digital assets, crypto, what do you want to call it, peer-to-peer, exchange of currency is the future. And I always make the point, and I just want to jump in with this. I always make the point that when you look at a disruptive technology, I always try and do it in reverse. And I say, if the incumbent was swapped for the newcomer, what would it look like? So for example, say you wanted to set up a bookstore company, but Amazon had been around for 100 years, and you went to the bank and you said, well, give me a loan because I'm going to put some high street shops, I'm going to put a few books in them and pay staff, and I'm going to disrupt Amazon. You'd be laughed at, right? And similarly, if the Swift bank transfer system didn't exist today, would you build it? I mean, would you build that system where when you pay for something on Amazon on your credit card, you have to move money to your credit card company, to your bank, your correspondent bank, my correspondent bank, etc., when you can do PayPal with one person in the middle? Well, we've now gone one step further and it's direct. So I think institutions have seen that this is not a new invention, exchanging money, exchanging without anyone in the middle. It's not a new idea, but it's very clever and it's been around and it's made great returns, and they feel they need to learn about it, and therefore to learn about it, you need to invest, and probably invest in multiple different strategies, be they tokens, be they crypto, Bitcoin itself, be they VC. So I think my ideal client is an institution who wants to grow with the space.
Grow with the space. Very good. Thanks for that. And Brian, you've got a more traditional site for a capital group, in that you've got your homepage and then some disclaimers. So I think it would be revealing to a lot of us who can't do our traditional website check. Same question to you, sir. I mean, as a bit of an insight into how you operate in your philosophy, who do you see as an ideal investor?
Yeah, I mean, I think the ideal investor here is somebody who can size this appropriately. I think that's the key to this space. So as Dan mentioned, it's an incredibly volatile space. It is the most volatile asset out there. That's where the opportunity comes from. But at the same time, you need to be able to size it appropriately. So let's call it 1 to 5% of your portfolio. And the reason why that number works is, if we're all right, and this is a 100x opportunity, that 1 to 5% is going to add a lot to your portfolio, a lot of alpha to your portfolio. If we're wrong and it is not 100x, okay, so it's a 1 to 5% loss, and I don't think this stuff is going to zero anymore. Years ago, that probably was a chance, but at this point, we're well beyond that. So I think, you know, you have to make sure that this fits into your portfolio in the right way. I wouldn't put 50% of an institutional portfolio in this at all, but 0.5% to 1%. And if you look back over the last several years, what's interesting about that is if you did that, you would really increase your Sharpe ratio. So your volatility doesn't go up that much, but your returns go up significantly. And that's an asset that I think any investor would want to have in their portfolio.
Thanks so much for that, Brian. And, you know, you bring up these numbers, and thanks for reminding us. I mean, you're diversifying. You're not, hopefully not putting more chips than are warranted. You're doing your homework and allocating a reasonable amount of your portfolio. And I thought it was interesting because, yes, you bring up the 1 to 5%, and we're finding that our Asia investors are willing to go double that on average. But Jeff, you're known as a numbers wizard, and you know Brian has brought up that, hey, let's go 1 to 5%. Let's bring up this. The markets are crazier than ever. You know, I believe Goldman Sachs has just kind of nailed their warning to the wall about a decade of low yields. Would you agree that 1 to 5% is the way to go for? Let's talk about alternatives. And say I'm an Asian investor, and I'm saying I'm ready to go 10% on digital assets. Are you going to say, whoa, Nelly, you should be 50-40 bonds and equities and spread out that 10% with gold? Or what do you think in terms of those kind of numbers, given the kind of race to uncorrelated alternative assets?
Sure, thank you. You know, I'm a very good asset manager. I'm a very good risk manager. My job is not to be a wealth manager and to help people understand their allocations. You know, the institutional allocation world is very good at figuring out the right allocation mix when they understand what the risk and reward of each opportunity is. What I will say is that I think this industry has come a long way from 3 or 4 years ago, where it was just, we're going to buy Bitcoin for you, and therefore you should put a small percentage of your net worth in here. As we said earlier, this is a huge and growing asset class with a lot of different opportunities now. And we try to set up our fund that anybody who wants to put 100% of their assets can. You know, we have a sleep at night fund. We are not, you know, subject to the volatility of Bitcoin or cryptocurrencies. We are finding real assets with real value, where if you want to put your entire portfolio in our fund, you could. Now, of course, I'm not suggesting that anyone does that. Everyone should run their own analytics and their own you know, asset allocation models. But, you know, again, our ideal investor is someone who believes in transformational technology and innovation, but isn't afraid to deviate from the herd. And if you believe in tokenization, there's a lot more to this than just money in cryptocurrencies. I believe digital assets will be the third part of the capital structure for many companies. And ultimately, you're going to have debt, equity, and digital assets in your capital structure. And as a result, you know, the Starbucks of the world, the Amazons of the world, they're all going to have a digital asset at some point. And, you know, we have a 3 to 5 year head start before the Ares and the Oak Trees and the Blackstones get involved in this space, where we can create value. So if you believe in tokenization and you believe in value capture in something that very few people are focused on, and you believe that there's an active manager like myself or others in the room who are good risk managers, you know, put as much as you believe in a fund like ours, and we'll manage it accordingly.
Super. You know, I'm so tempted, Jeff, to follow up on your comment on being excellent at managing volatility when, you know, Arca focuses on capturing alpha in small and mid-cap digital assets. But I would like first to give Kyle a chance, because you're also talking about this belief factor. And it's a very good kind of dividing line or unifying line, isn't it? Because Kyle, I'd like to give you a chance to answer the question about your ideal investor the same way, because here you are focused on seed stage projects, and you go multiple rounds with of equity with smaller projects that you believe in. I think it would be fair to say you're the most kind of visionary money manager on our panel. So does that belief factor, would you agree or expand on that and say, yes, you know, if you're looking for, you know, a short-term alpha or growth, forget it. We're looking at more long-term growth in the space.
So I'm flattered by the comment. I'm not sure I'd go that far. A lot of the folks on this panel here are pretty smart and have pretty good thoughts. Where we spend, so our ideal investor is someone who wants to bet firmly on the crypto space for some minimum time horizon, let's say 3 years minimum. And they're willing to underwrite some volatility between here and there. I think that though is true for everyone here. Having folks coming into another fund on a quarterly basis in crypto is just kind of counterproductive. There's just a chance your first quarter is bad. So on someone with that kind of time horizon, most of our investors today, we run about 100 million across 2 funds, and most of our investors today are large family offices. We have a handful of institutions and endowments, and a large number of kind of famous technology celebrities out of Silicon Valley, guys like Andreessen and Fred Wilson and New Square Ventures and those types of folks. That comprises most of our LP base. As we grow, our LP base is becoming more and more, let's say, traditional. Today it's skewing towards family offices, and now some endowments are making their way in. Our view is that, yeah, if you have the reasonable time horizon, then you can kind of pick your fund strategy, either venture or hedge fund. That we provide one strategy for each of those, but all based on kind of fundamental research and understanding. The other really interesting thing in crypto is there's a lot of ways to make money having a fundamental worldview that's not a 10-year venture view. There's a lot of things in crypto that I believe will be, say, meaningfully higher in price 12 months from now, but I believe maybe 6 years from now, maybe much lower in price. And like the crypto space is full of those kinds of opportunities. And because this space is liquid, there's tremendous opportunities for alpha there. One thing I've had to really reorient my head around over the last few years being in the space is that I shouldn't, given these assets are liquid, I don't need to force everything to the venture tier of I want to be long this thesis for 5 to 10 years. But there's still a lot of opportunity, even on a fundamental basis, on, let's say, a 6 to 24 month time horizon.
Great. Thank you for that. And, you're talking about your long-term time horizon. Of course, we all have to think about that. Let's flip the script, though. Desiree, a lot of air has gone out of the souffle. A lot of the excitement has left the room towards cryptocurrencies lately, because we all talk about long-term, but at the end of the day, we follow trends. We're not immune to hype and market cycles. And, when crypto failed to be, at least let's say Bitcoin failed to be inversely related to the stock market, a lot of people kind of lost, I don't want to say lost interest, but they decided, let's put things on hold for now. How are you seeing this kind of flatness in the price of Bitcoin?
I cannot hear you. Ernie, are you still there? Oops. So then I guess I will just start answering his question, which probably began with the large drawdown we saw in March, not only in the crypto space, but in the entire asset space, including equities, gold, and all asset classes. And actually, with our strategy, we have 2 alpha generators. One is the asset allocation. So we decide how much exposure we effectively want to have to the market. And the second alpha generator is the token selection. So as we saw markets overvalued by the end of February, we actually decided to cut our exposure in half, which gave us great opportunities to buy back these tokens at very cheap prices when the market crashed in March. And we were able to build up our portfolio to 100% again. Of course, it was disappointing to see that Bitcoin was correlated with the other asset classes. But actually, this is always the case when such a shock happens in the market. Everything is correlated first because everyone tries to fly into cash, and there are a lot of margin calls, so people need to sell and get into cash first. But in the medium term, we saw that Bitcoin actually recovered quite well and fast from the large drawdown, even faster than many other asset classes. And over the medium term, we actually see no correlation to other asset classes. With regards to the flat development of Bitcoin in the last couple of weeks or months, we actually, or this is the second part of our alpha generation, the token selection. And we actually do not just look at Bitcoin itself, but we look at the top 50 tokens and model them with our fundamental analysis. And we actually create a basket of around 10 different tokens that we invest in on average. And the tokens we invested in were performing quite well. We actually doubled our assets just because of the performance this year. I mean, we had a performance of 100% this year because of our exposure to altcoins, to alternative coins.
Congrats, impressive, that's excellent. And you know, you bring up your fundamental analysis, and that's kind of a buzzword in this space, Desiree, because you know, I'm sure you guys, I wish I had you guys with me when I was arguing for the fundamental approach to some blockchain companies. But you know, in the traditional space, a lot of people will just scoff when you say that you can do fundamental analysis of blockchain projects, given the lack of transparency, the lack of track record, etc. Lee, I'm sure you run into these objections, having come from the traditional world as well. How would you respond to that objection to the many institutional investors who are perhaps not as sharp as yourselves on the panel?
I think I've had a lot of no's from investors over the years, and I think once you get to a no, I think that it's very hard to persuade them. I think the reality is you've got to persuade them at the early stages that they like the idea. You've got to persuade them that they're going to be able to sell it further up the chain, because often they're gatekeepers. You've got to make sure they understand the risks involved. But I think, you know, Brian said it very well earlier. I think it's having a very small allocation to some of these strategies with 50% downside, but you know, several 100% upside is going to enhance your portfolio. And I think once they can get their head around that, I think in some cases it's not that they're not doing it because they want to improve their returns. It's because they don't want to be left behind their peer group. And some of it is actually just drawn by that. I think that's one of the big changes with last year. You know, with the likes of Yale and the likes of Paul Tudor Jones, some of these more respectable groups, they've made it easier for people to get invested, but more importantly, made them fearful that if they're not invested and they underperform by 5-6% because they don't have a 1% exposure, they have to be in. But no, my experience is once they're a no, you need to just put in your diary 3 to 6 months later, when Bitcoin's higher again and crypto's higher again, to just phone them back again and see what you can do. But no's are very hard to turn around.
That's of great value to folks like myself. Thank you, Lee. That's always, you know, talking to institutional investors and, let's say, guiding them in their decisions. But really, maybe I mishandled the question. I wanted to dig into this fundamental because, you know, when somebody from the more traditional side tells me fundamental analysis in the crypto space, pshaw, or some similar sound effect, Desiree obviously is well versed and a believer in the fundamental side. You know, I'm talking fundamental versus technical. You've got investors that say, well, I hope this fund is mainly talking about Bitcoin futures and things that lend themselves to, you know, technical analysis, as opposed to trying to fundamentally value blockchain companies. Brian, what do you tell? Have you run into this question? What would you tell someone with this kind of attitude?
Yeah, so, you know, in terms of the fundamental analysis of crypto, ultimately what we're talking about is network effect. So you can kind of apply some of the same techniques that you might have to internet companies that you did in the 90s, where eyeballs, or Twitter or Facebook. What are your monthly active users? You know, that is the exact same thing that you have here in the crypto space. You can look at addresses. We focus a lot on address growth. So, you know, if you start to see address growth, that's akin to seeing MAUs going up for Twitter or for Facebook. And that is as fundamental as it gets right there. That's what everybody uses. So, you know, I think there is a way, and we're all kind of learning. Everybody on this panel is a pioneer in this space in terms of how you analyze this asset class. But that being said, doesn't mean you can't use traditional techniques. Doesn't mean that we don't use that. In terms of, technicals, what's kind of interesting is that, much like the foreign currency space, a lot of my background is in spot foreign currency. These assets respond quite well and act quite well with the technical. So, for us, we use kind of a blend of both, right? And ultimately my job is, to make money for investors. And, when I write the monthly letter and say we're up X%, most people don't care if I did it with technicals or fundamentals. We do both. We kind of call ourselves a quantamental shop. But ultimately, what matters is what works. And in this space, the combination of the two actually works quite well.
Just jumping back in, Ernie, I think just to answer the question again, I also make the point, and the Argentinian peso, whatever it's worth, 500-600 billion, air miles, 750 billion, which, by the way, just recently, American Airlines and Delta have securitized bonds against their mileage program. And yet, you say to people, do you think crypto is worth nothing, 5 billion, 10 billion? They say, no, it's worth something. It's internationally used. It's used globally. It's a global phenomenon. And I say, well, do you think that's more important than air miles? They might say no. I say, well, do you think it's more valuable than the Argentinian peso in a country that's bankrupt? And they say, yeah, pretty sure that's the case, right? And then, you start going through it. And there are a number of currencies in the world that are traded with less liquidity daily, that are worthless, fiat currencies, have bankrupted several times, that the actual value of them in circulation is much higher. So, you start looking at a relative value. Big cryptocurrencies or digital assets, what do you want to call them? Yeah, they might be niche and they might end up being 5 billion for gamers only, but if they're going to be global and used by everybody, they're trillions. There is no middle number. There's no 165 billion number where that's the value, right?
But
when you put it in that perspective,
I'd say a lot of these answers too, just to jump in here, and I apologize, Lee, a lot of these answers thus far have been focused on cryptocurrencies themselves, right? The actual currencies, the ones that are trying to be money, whether that's Bitcoin, Litecoin, et cetera. Again, there's an entire universe out there, which is digital tokens issued by real companies. And some of these tokens have properties with real cash flows and real yields. And you can analyze these in the same way you do traditional instruments. So there is a whole universe of assets out there that can be modeled. I mean, I have a member on my team who has 15 years of experience at KPMG doing international M&A modeling, and he has a JD and a CFA. And he's far more valuable to my team than anybody with a technology background or a venture background looking at the future, because we are really looking and modeling the value of these companies and the tokens that they're issuing in their capital structures. One of the things we talk about is, equity is obviously a claim on future cash flows, and debt is a claim on asset value. Both of those are very susceptible to a recession. If there's less spending, there's going to be lower revenues, and there's going to be lower profits, and there's going to be lower asset value. But digital assets are a claim on future network growth and future participation in a company, just like airline miles, where Lee mentioned. Those don't go down in value. Those still exist. So you can argue that this asset class is actually more recession-proof than anything else, if you find the right companies that have tokens that actually accrue economic value.
Fantastic insight.
Can I jump in here, guys? Just that, given the area that we're on, I've obviously got questions that were submitted by the attendees when they registered for the event. And one such question, I think, fits well of where we're at with this discussion. And it is, how do we calculate fair value and fine value in this asset class, whether it be in digital assets or cryptocurrencies or early stage tech companies? I just find that's kind of fitting with where we are now. So does anyone want to I'll put that out to the audience. Does anybody want to take that one on board? So how do we find fair value either in digital assets or in early stage tech companies?
I'll start off with that one. So there's different styles of assets. I think Jeff alluded to kind of 3 or 4 different types of assets. For the simplicity of answering this question, we can just think of some assets as capital assets versus cash assets. No one tries to value dollars against euros, because they're not valued against each other. They're priced against each other. And obviously there's lots of people who trade, euro dollar curves and whatever, like all these things. But no one actually thinks there's like a fundamental value model between euros and dollars, because there's no exogenous cash flows out of euros that produce dollars. So Bitcoin and a large number of other assets in the space kind of fall into that broad bucket. There are interesting ways to do relative value models and stuff in that space, but there's no absolute fundamental value in those types of tokens. But as Jeff was just alluding to, there's a lot of tokens that actually do have that. So one example would be an asset called Arweave. Arca is kind of like, think about it as Airbnb for your hard drive, or you can like rent out hard drive space and get paid for doing so. In that system, you can actually model very clearly demand coming into the network, how much stuff do people want to store, and that's completely transparent and auditable in real time. And you can see what the cost of storage is. And then you can see there's some kind of clever cash flow mechanics and like how cash flows flow through the system. And you can actually measure in a very direct way, like how many net new dollars are flowing into the Arweave asset. And you can project that with some reasonable level of precision. The exact growth curve is always hard for these things. And they can kind of step function change pretty quickly. But like those kinds of opportunities are very much out there. And actually, the even better part is a lot of the information is public, but not easily observable. So like if you go into the Arweave Discord, which is like a public chat room with the Arweave developers, like, do they say, hey, these are 10 people are going to come online next week and start adding data to the network? Like, no, but you can just go on there and ask them and say, hey guys, like, are there net new interest developers who are going to start putting stuff in this thing soon? And there's a good chance they're just going to answer your question. And like that's a public forum, completely public forum. But like, is that in a K1 registration or some other disclosure document? No, but it is public. And so there's all of these kinds of interesting opportunities, both to find alpha and to be able to measure with some precision what fundamental value is, that are really like, that's the bread and butter for folks like us. I suspect Jeff spends a lot of his time on stuff like that as well, as do the other folks on the panel.
Thanks, Kyle. But yes, Jeff, you alluded to that as a universe, and from where we're sitting anyways, this is still quite nascent and hasn't attracted a lot of attention, but you do see that having said that, yes, now we realize there is a good swath of digital assets that bear up to fundamental analysis very well. Is that a significant portion of the ecosystem right now, or are we waiting for that to happen?
I mean, from a market cap standpoint, obviously it's small, right? Bitcoin is, Bitcoin and Ethereum alone make up what, roughly 70, 80 or 80% of the market cap. So, most of this universe right now is in the small to mid cap realm. So you definitely, you need an active manager who is the dedicated time to do research on this space. I think of it a lot of times as if anybody in the room has ever invested in a healthcare fund, most people who invest in healthcare don't really understand how hospital readmission rates work or how Medicare reimbursement works or how phase 3 drug trials work. They just believe that healthcare has a space in their portfolio, and then they go find a manager or a representative, a fund that is going to give them exposure to that space. And I think that's what most investors need to do in the digital asset space right now, is recognize that there is a need for this in your portfolio, that it's a real asset class that isn't going away, and it has characteristics that are different than your traditional real estate, fixed income, equity buckets. And then you need to find somebody who has a strategy and a investable universe that matches what you believe in, and let them do what they're good at, which is finding this value. There is tremendous value in this space if you're looking for it, and it has evolved quite a bit over the last 2 years. And you need a strategy and a manager that is evolving with the space. Bitcoin is a great investment. I love Bitcoin. Bitcoin has a small allocation in our portfolio. But if you believe that Bitcoin is the entire space, it's just not true anymore.
Excellent. Well, you certainly capped off the second phase of diversification, which is the argument for investing in a digital asset hedge fund. Ladies and gentlemen in attendance, I think you'll agree that if you were to try to undertake research and investment on your own part, whether it's in this sector, the universe that Jeff and Kyle just spoke to so eloquently, and Desiree, that bears up to fundamental analysis, or whether you're using algorithms to do technical trading in Bitcoin futures, active management is a very good idea. And it does kind of fit that diversification mandate. So here's basically the last question, and I don't know how long it'll go, but the hope with Block Asset Management and LehmanBush is we were kind of leading you into having to admit. And Dan, I'll beg the question, because at a recent Bloomberg Digital Asset panel, you mentioned that it makes sense to spread out your allocation across a lot of products, or maybe you may have said even across a lot of managers. So there it is, guys. I mean, ladies and gentlemen in the audience, you should know that Block Asset Management invests in all of these great funds. We can't pick just one. Dan, do you agree that it makes sense for triple diversification, as we've laid it out tonight, to invest in a fund of funds, or are you going to make the argument for one fund above all?
No, I do. And we've actually lived this. There was a time we were the only fund in the asset management space, and we only offered one product, and that fund only had one asset in it. So Pantera Bitcoin Fund was the only thing out there. And we went around to Yale and Stanford and everybody, and we pitched that, and it didn't work. Nobody wanted it because there was no diversification. And I think that is one of the big reasons that institutions are now allocating to the space, because there are, a half a dozen, very reputable firms. Each of those firms has 2 or 3 funds, and each of those funds has 30 different assets. So an allocator can actually build a portfolio that's diverse, both in terms of asset types, but, managers, all those kind of idiosyncratic risks. And so I do think it's very prudent for an investor to begin with some kind of diversified fund of funds type approach. And then, yes, if they become an expert in the space, maybe they want to start doing more single manager stuff.
Thank you for that. Brian, care to comment? Again, our simple thesis is triple diversification. Get into crypto assets because you need to expose your portfolio to that asset class if you're at all interested in growing with the space, keeping up with the times. Get your that section of your portfolio actively managed. What do you say, Brian? Fund of funds is a great way to expose yourself to fantastic funds like yourselves.
Yeah, so I think fund of funds have gotten a bad rap in the traditional world because people say they're laying fees on top of fees. I actually think the crypto space is the one space where fund of funds makes all the sense in the world. You're talking about a new asset class. It's incredibly difficult to travel around the world, and I know you guys have done this, and visit every asset manager. There's only a handful out there, and each of us invests in different types of assets, right? So you run the gamut from, our fund, which is in the top 20 or so, and we tend to look more like a long-short fund, whereas you might have something like a venture fund. And you can get exposure across that asset class. So not only can you reduce by investing in this space, you can reduce your kind of, you can add to your alpha, but by using a fund of funds or investing across funds, you can actually kind of mitigate some of the risk in this space. And you're going to have years, as Dan said earlier, you're going to have years where this asset goes down 50, 70%. It's new. This is just what they do. That's the opportunity. But in those years, if you're invested in, let's say, a fund of fund, or you're invested across funds, and maybe the venture funds are actually doing well that year. So it gives you diversity there, diversification there.
Thank you. I'm so glad we're recording this. I'm going to be studying this because thanks for making my case so eloquently, Brian. But let's do some high school debate team. Who wants to speak against fund of funds? We'd like to hear the opposing viewpoint. I have the feeling maybe Desiree or Lee, you have some insights about do your homework, find a fund manager that you really share the vision with and have a good relationship, and go with them. Does anyone want to comment? Lee, Desiree?
I mean, I think it really depends on the portfolio manager skills in the end. It's the same as with a fund like ours. You guys also have to choose the portfolios you want to invest in. You need to know what their strengths and weaknesses are, in which an environment they work very well and in which ones they don't. And potentially you also have to actively manage this. So I think in the end, it all comes down to the skills of the portfolio manager again. But I also think that fund of funds take out some volatility, and they are a certain hedge in difficult times, as was mentioned just before.
Thank you for that. If anyone else wants to weigh in for
I don't totally agree with Desiree there. I think that's not completely true. I think the portfolio skills are obviously important, but you've also got to do a lot of due diligence in any fund of funds business. The people maintain that they're still doing the right things. They need to make sure they've got the right custodians, the right infrastructure. You've got to keep on top of that every quarter, maybe every 6 months, as Brian said, travel around the world. So some of what a fund of funds does in any sector is mundane, boring, and a service. And you pay for that. There's a fee for that. And then on top of that, there's some portfolio allocation skills. And in some cases, that is the most important factor. But the other point here is we're talking about big institutions with maybe even $10 billion allocating 100 million to crypto, and therefore having to do all that work and have to put a team on it and distract from their 30 or 40% they have in credit or fixed income. I mean, it just doesn't make any economic sense to do all that due diligence work and the portfolio allocation work, everything else, for the savings they would make doing it in-house versus going to a fund of funds. So, you know, I think there's two sides to it. Fund of funds do get a bad rap. They do provide a very important service, which is doing the check, or should be doing a very important service, doing the checks on the companies, individuals, talking to their auditors, talking to their counterparties, talking to their peers, but also, you know, maybe some asset allocation. And I think in this particular sector, asset allocation is very difficult to prove that you have pedigree, very difficult to show that you have an edge because the track records are short. So, you know, the key issue here is, I think a large proportion of the fee is actually finding the managers and making sure they are reputable and have all the right processes in place.
Processes. Thank you, Lee. I'd like to put a bow on that, and thank you all for just talk about delivering. I think you'll agree, ladies and gentlemen. I've learned so much tonight. Great points. Thank goodness we've recorded this, and I'd love to go on, but we did tell most of our audience that we'd go an hour, and as you can imagine, our panel have a lot of things in their day besides this webinar. So I think what we'd like to do at this point is Kevin is going to take over the Q&A, and I imagine you must have some questions out there in the audience. So having gotten this very gentle and nice handoff for the fund of funds, Kevin, would you care to tell quickly, please, about Block Asset Management's UVP, and then we'll move right into Q&A?
Of course I will, and some very, very valid comments all around there. What I'll say is that in 2017, the Asset Management started our due diligence process, analysing the digital assets universe in order to find the best managers and the most investable funds within the space, so that we could launch at that time the world's first digital assets and blockchain focused fund of funds, which was back in January 2018. Now we have almost 900 funds in our database at present. So you can imagine the ongoing task that is carrying out this due diligence, as Lee rightly mentioned, and it's lengthy due diligence that we, the team, undertake. And you know, for the audience there, we can confirm that, and as you have mentioned, Ernie, we do allocate to the 6 exceptional managers that are on the call today. And again, hitting the nail on the head there, Lee, is that you have to do the amount of due diligence to acquire the right funds in making sure that each fund has the right counterparties, has the right auditor, custodian, strategy, managers, experience. So that's what we do. So Block Asset Management are in essence a giant risk filter, we believe, in selecting the right funds within this universe, and therefore giving exposure to the digital asset space via the best managers, and therefore reducing both risk and volatility. So in a nutshell, that's what we do. So I agree with everything said there. You know, they're all very valid comments.
Thanks, Kevin. And we're going to move into Q&A. And ladies and gentlemen in the audience, I think you can appreciate what a rare and great opportunity this is. We've got these superstars. Good luck getting Brian or Lee or Dan on the phone or something with your questions. Let's hear what you've got. And for the many fund managers out there on the list, we know you're out there. Go ahead and take a shot at the champs. Let's hear some good questions.
I'll start from one that I can see on the panel, because I've been flicking through that as we've been talking. So I can see somebody here, Alberto, has put on here to all panelists: how do you believe CBDC is going to affect Bitcoin? So it's an interesting question. Anyone want to take that one forward?
I'm happy to jump in on that. So the central bank digital currencies, for those that are unfamiliar with CBDC, I don't think they're a threat to Bitcoin at all. I mean, to Bitcoin and a lot of these other currencies, you're talking about you'd have the ability to opt into a particular monetary policy. And so with Bitcoin, similar to gold, the monetary policy is fixed supply. We're not going to print any more money. So whether or not a dollar or a yuan or a yen is digital or not. We effectively have that already. They're already digital. What you're investing in or what you're putting your money into there is the monetary policy of the country. And what we're seeing, obviously globally, is they're just printing a lot more money. So I think it's interesting. I think it's good for the space that central banks are in it, that the technology is validated, that this kind of new technology is saying, hey, this is good enough for central banks. It's got to be good enough for everybody else. But I don't think it's a threat to Bitcoin or any of the other currencies that we all invest in.
I'll go maybe a couple steps further, actually, to add to that, which is, you know, at some point, every investment committee over, let's say, some period between 1996 and 2005, had to sit down and say, okay, like, what is the internet, and like, what is information, like, what does moving information around mean? Like, what are the impacts for society? We started to do things like Google, and that started to kind of like make this more real. And I think what central bank digital currencies do is they force every investment committee on the planet to sit down at some point and say, wait a minute, like, just to rethink, how does the current financial system work? You've got central banks and then commercial banks, and then how money kind of flows through the system. And if you sit down and then you're forced to rethink about it, and there's some new model from the central bank, it just forces you to also look at the kind of adjacent thing, which is, you know, Bitcoin, Ethereum, Libra, whatever. And so in that sense, central bank digital currencies are good because it just creates new attention to go look at crypto things that would otherwise not dedicate its attention towards the asset class.
Great. Another question that was pre-submitted, and one that I've been asked several times myself. During the recent COVID-19 led crash, the crypto market also fell in line with traditional markets, when obviously it's supposed to be an uncorrelated market. Can anyone in the panelists sort of give their explanation as to why there seemed to be a coupling between the digital asset space and the traditional markets?
Kevin, I'll do that if you like. Bitcoin is uncorrelated with all assets, with the exception of very, very steep spikes in down risk scenarios. And so there have been 5 since Bitcoin has been frequently traded. And in each of those, Bitcoin's been highly correlated for an average of 31 days. And then over 73 days, that correlation fades back to its essential 0. And that's actually what's happened here. Is in the early part of March, Bitcoin was highly correlated with the S&P, and now it's not. And I think Ernie's earlier point, I want to stress to participants, is you should have some money invested in an industry where you're complaining that it's only up 30 to 100% during a once in a century pandemic and financial crisis, right? All other assets are down. Most hedge funds haven't really made money for years. Ernie's asking, hey, why isn't Bitcoin up more? Bitcoin's up 30%, Ethereum's up 90, our funds are up 60 or 70, and people are saying, hey, why isn't it even more? That's the biggest advertisement for why you should have some assets in the space.
I'd also just quickly say there's a very big difference between flight to quality and safe haven, right? A safe haven literally means refuge from something, right? And in the Bitcoin's case specifically, this is a refuge from a collapsing fiat currency policy and monetary policy, and potentially, like, you know, your own government collapse in certain areas of the world. Flight to quality means you're moving into it quickly to preserve cash in some sort of a, you know, downdraft or some sort of a crisis type mode. So just because Bitcoin did not act as a flight to quality during a very highly correlated period of all risk assets doesn't take away the fact that it can still be a safe haven for people looking to get their money out of an existing system that has been failing them.
Okay, another question that's been submitted here, we can see on screen, is do you see the digital assets industry moving towards tokenizing their funds? What are the advantages or limitations in your point of view?
Yes, we definitely see that, and we actually would love to tokenize our fund too. The issue currently is that regulation is not there yet. So it's not possible to trade these security tokens on exchanges yet. And if it's not tradable, it's not a big advantage for us. But I'm sure this is going to come in the next in the early future.
Anybody else?
Maybe one thing to add, what I would appreciate more about the tokenized fund is daily liquidity. It would be much cheaper to handle such a portfolio as a token. And yeah, I would appreciate that a lot.
Thank you very much, Desiree. I'm conscious we're 10 minutes over, so I'll just go with one more question, which is again pre-submitted, which would be, what factors could drive demand and adoption in 2020 and beyond? So again, I'll just open it up to the audience, guys. I think we might all have an opinion on this.
Maybe one more thing to add to this question. So I think actually Corona was the ideal environment for our fund strategies or for the crypto space overall, because people start questioning a lot of things, a lot of the existing infrastructure, banks and governments. And I actually also think, especially here in Switzerland or in Europe with the negative interest rate environment, and really the question, where do you want to invest when equities have already had a huge performance, and real estate as well? So how do you diversify your portfolio? Where do you get the return from? I think people really start thinking of diversifying into crypto also after the drawdown we had, and they saw that crypto survived and actually behaved quite stable afterwards. So I think this environment helped a lot to make people aware of the opportunities in the crypto space.
Yeah, I would add to that this is the exact environment that crypto and Bitcoin was developed for. If you remember, it was 2009, right after the crisis, that this was released, and it was because people were concerned about the traditional financial system. And so here we now have the response to COVID-19, which is every central bank expanding money supply, which is exactly the time that, as an investor, you want to buy things that have a fixed supply. So real estate, there's only so many houses out there. There's only so many buildings. Gold and silver, you're seeing those do quite well. And then crypto. And so I think in this environment, this is the place to be, in my view. If you're just looking at it pure portfolio wise, how do you want to invest in an environment where every central bank is printing money? You want to invest in fixed supply assets, and that's what crypto represents.
Excellent.
When Satoshi created Bitcoin, he put the quote from the Times of London in there about being pissed off that the Chancellor had just done £50 billion stimulus plan. The United States had a deficit last month of $1 trillion, which is just Satoshi, like that's just orders of magnitude bigger than he or she or it was worried about. And that is equivalent to the first 204 years worth of money printing in the United States. So it's time to own something that has a fixed quantity like silver or Bitcoin.
I think the answer I would give to this question, Ernie, is that what would drive demand, drive it up, I think is real usage of the blockchain. And we're seeing a little bit more of that in the shipping space. We're seeing it in a few other spaces in trade finance. I think what we'd really need is to see an acceleration of the adoption of transactions on the blockchain that are not trading related, that are real world related. And I think if that were to happen, I think you would see, a bit like the air miles industry, you'll see another exponential growth phase in the crypto space.
That's it for questions my side then, guys.
We have time to extend, Kevin?
If you feel necessary, yeah, I'm out questions my side.
Yeah, I mean, granted the time limitations that we promised are a very busy panel, unless someone is coming in now, why don't we wrap things up? Because, ladies and gentlemen, thanks so much for being with us. And do remember these names: Dan Morehead of Pantera, and Desiree Muller of SwissRex AG, Jeff Dorman of Arca Funds, and Lee Robinson, Altana Wealth Fund, Kyle Samani of Multicoin. Don't forget that Block Asset Management is invested in all of them, and we've talked about triple diversification tonight. But if you're interested in any of these funds, any more information or introductions, that's what we're here for. And we're going to be sending you the presentation link and more info. And yeah, I just, there should be some thunderous applause at this time, I feel, for our distinguished panelists. Ladies and gentlemen, thank you so much for your time and your great insights. It means a lot to us, and we thank you deeply.